Hi, everybody. Welcome back to video number 3 in Chapter 8. And when we left off, we were looking at woodland developers and how they use relative sales value to determine their cost per lot. Here we have our number of lots, the selling price per lot, and the total selling price. Now we simply take a percentage of areas A, Alpha, Bravo, and Charlie as a percentage of 2.5 million. And that gives us 40%, 24%, and 36%, which of course will always add to 100%. We'll multiply those percentages times the total cost. In this case, $1 million. So we will allocate that $1 million to the selling price. And if we go back, here is the different prices and the $1 million that it purchases that it's going to subdivide. So that $1 million, we will divide that by the relative selling price here. And that gives us 400,000, 240,000, 360,000, or $1 million. And so then we can just simply divide through by the number of lots here, and that will give us the cost per lot, $4,000, $2,400, and $1,800 for areas Alpha, Bravo, and Charlie. Okay, gross profit using relative sales value. Now we're going to use the information we just calculated about woodland developers in the previous example. And in this case, Woodland's going to sell 77 Area Alpha lots, 88 Area Bravo lots, and 100 Area Charlie lots. How do you compute Woodland's cost of lots sold and gross profit? I think this is fairly intuitive, as I think you'll see. Here's the number of lots that we sold and the cost per lot that we calculated previously. And so that gives us the cost of lots sold. If we add that all up, comes out 680,000. The selling price was based on 77 lots times $1,000, etc. And our total sales were $1,700,000. So our gross profit then can be calculated by the individual areas Alpha, Bravo, and Charlie at $1,020,000. So as indicated on the worksheet, the cost of lots sold is $680,000. The gross profit, $1,020,000. And the ending inventory is going to be the $1 million beginning inventory less this cost of $680,000 for a total of $320. Pretty straightforward, I think, there. Okay, other valuation approaches. Purchase commitments, a special problem. What are purchase commitments? They are agreements to buy inventory weeks, months, or even years in advance. I know with me, we used to sell 1 million burritos a day. And that you can imagine we used a lot of pinto beans. So we would contract with farmers that for a whole year's worth of their crops and purchase all of those beans that way. So generally, then the seller is going to retain title to the merchandise, and the buyer recognizes no assets or liabilities. But if the contract price is greater than the market price, and the buyer expects losses will occur when purchase occurs, the buyer then should recognize losses in the period when such declines in market prices do take place. And in my example, the price of pinto beans varies quite a little bit over the course of a year, and for that matter, year to year. All right. Starbucks is going to sign a contract in early 2025 to purchase coffee beans in 2026 at a price of $10 million. Assume further that the market price of the coffee beans at the end of December 31, 2025, dropped to $7 million. Starbucks is going to make the following entries on its December 31st, 2025 and March 30th, 2026. Okay, and here, to record the loss, the difference between 10,000 and 10 million and 700,000. Let me try that again. 10 million and 7 million, we get 3 million loss on purchase commitments. And the credit is going to be estimated liability on purchase commitments. Okay. Starbucks would report the loss in the income statement under other expenses and losses. And because the contract is to be executed within the next fiscal year, Starbucks will report the estimated liability on purchase commitments in the current liabilities section of the balance sheet. Now on March 30th, we're going to record the purchase of the inventory. And here we're going to debit purchases for the inventory of $7 million. Estimated liability on the purchase commitment, $3 million. And we'll pay the full amount in cash of $10 million. The result of the purchase commitment was that Starbucks paid $10 million for a contract worth only $7 million. It recorded the loss in the previous period when the price declined in the previous period. Okay, let's take a look at accounting for relative sales value and purchase commitments. Now it's a little more complex. Remote Incorporated buys 500 USB speaker microphone headsets from a distributor that's experiencing a decline in demand for those products due to the growing popularity of Bluetooth technology. The purchase price for the lot is $8,000. Bell will group the headsets into 3 price categories for resale, as indicated below. So here we have group 1, 2, and 3, the number of headsets, and the price per headset. Now we want to determine the cost per headset. We'll do alpha first and then come back to Bravo here in a second. So we're looking for the cost per headset. And here, the number of headsets, the selling price. Here's the total selling price. We'll do the relative sales price here. And the total cost of $8,000. And then we'll multiply through 8,000 times these relative sales price, effectively percentages. And that will give us the cost allocated to the headsets here. Then we can divide through by the number of headsets to get the cost per headset. Pretty straightforward there. Now, if I look back at Bravo here, at December 31, 2025, Remote has outstanding non-cancelable purchase commitments for 12,000 USB cords at $2 per cord, which is raw material for a variety of Remote's products. The company prices its raw material inventory at cost or net realizable value, whichever is lower. So they want you to, 1, assuming that the market price as of December 31, 2025 is $2.30 per cord, how would you report this matter in the accounts and statements? Then number 2, assuming the market price as of December 31, 2025 is $1.70 per cord instead of $2.30. How would you report this situation in the accounts and statements? And finally, 3, give an entry in January 2026 when the cord shipment is received, assuming the situation in number 2 existed at December 31, 2025. And the market price in January 2026 is $1.70 per cord. Give an explanation of your treatment. Okay, so for Bravo, if the commitment is material in amount, there should be a note disclosure sheet stating the nature and extent of the commitment. The note may also disclose the market price of the materials. For number 2, the drop in market price of the commitment should be charged to operations in the current year. The following entry would be made. We would debit here loss on purchase commitments, $3,600. That's the difference here between $2 and $1.70 times 12,000 units. And that gives us $3,600, which is also the estimated liability on purchase commitments here. The entry is made because a loss in utility has occurred during the period in which the market decline took place. The estimated liability account should be included among the current liabilities on the balance sheet with an appropriate footnote indicating the nature and extent of the commitment. This liability indicates the minimum obligation on the commitment contract at the present time, the amount that would have to be forfeited in case of breach of contract. Okay. Now, assuming $3,600 market decline was made on December 31, 2025, as indicated in part in Bravo 2, the entry when the materials are received would be our raw materials are going to be $20,400, and we would set up a estimated liability on purchase commitments of $3,600, and accounts payable then would be $24,000, and that's going to be $24,000, and that liability represents, this entry records, I should say, the raw materials at actual cost, $1.70 per unit. It eliminates the $3,600 liability set up at December 31, 2025, and records the contractual liability for the purchase at $2 times 12,000, which is $24,000. The cost of goods sold in 2026 is $20,400. The additional cost of $3,600 is reported in income in 2025. Okay, this looks like a good place to stop our video. And when we come back, we'll take a look at determining ending inventory by applying the gross profit method. Until that time, bye for now.